Hello everyone. Good evening, good afternoon, good morning to all of you, whosoever is watching this lecture at whatever the time. So welcome to the another lecture on our CA final paper number 3, Advanced Auditing and Professional Ethics, a rapid revision batch for May and November 22 students, right? So as you all know that we have already covered section number 139 to section number 147 up to our previous video. So this is in continuation to that video where we are going to cover our section number 148, which talks about the cost audit, and along with that we'll immediately jump to our sections 128 to 137, which talks about the maintenance of books of accounts. Followed by that we'll cover the dividend chapter, and then as you all know that according to the plan we'll cover each and every chapter separately. Now 148 section talks about what? It talks about the cost audit. First of all, we have to understand, sir, cost audit is required on which kind of entities? Cost audit is basically required on those manufacturing, production, assembling, extraction, mining, and processing industries who have to maintain the cost records. Now the question arises, sir, what do you mean by cost records? As per rule number 3 of Cost Records and Audit Rules 2014, if you are being a manufacturing company and your turnover of the manufacturing company is more than equals to 35 crores, then it is mandatory for you to have what? It is mandatory for you to maintain the which records? Cost records. Which records, everyone? Cost records. If you are maintaining the cost records, then you may come under the cost audit. So there are so many myths about the cost audit, which I would like to first clear it out. Remember one thing, cost records are the records of raw material, records of labor, records of installed capacity, records of each and every manufacturing item which is available in your company. Cost records are those records. Are you getting the point or not? But cost audit is not a mandatory audit like a statutory audit. Rule number 4 of Cost Records and Audit Rules 2014. Rule number 3 talks about when the company, manufacturing company, has to maintain the cost records, and rule number 4 talks about its audit, cost audit. So remember one thing, just because you are maintaining the cost records doesn't mean that cost records are mandatorily required to be audited. For audit, there are separate rules, and for the cost records, there are separate rules. Are you getting the point or not? And one most important thing you have to understand, cost audit is not a statutory audit. Cost audit is not a statutory audit. Like a statutory audit, cost audit does not take place every year. It is not a regular audit. It is not a yearly audit. Rather, cost audit is also not a part of statutory audit. So if you are a manufacturing company, you are maintaining financial statements and you are also maintaining what? Cost records. So on the cost records, cost audit will take place. On the financial statements, statutory audit will take place. It means there can be a manufacturing companies, production companies, and extraction mining companies where the raw material and labor is being used, they may get the two audits at one point of time, cost audit as well as what? Statutory audit. So don't be under the impression that cost audit is a statutory audit. No, cost audit is not a statutory audit. Statutory audit is an audit of financial statement. Cost audit is the audit of cost statements, cost records, cost principles, cost accounting, all those things. It's a complete different set of life. Who are the most eligible people to do the cost audit? Obviously, practicing CMAs are the only people who are eligible to do the cost audit. Sir, only? Yes, only. Like secretarial audit, only practicing CS can do. Likewise, cost audit, only practicing CMAs can do. So what is our question number 1? Is cost audit a statutory audit? Answer is no. Is cost audit a part of statutory audit? Answer is no, because cost audit is in addition to statutory audit. So it is not a part of statutory audit. Statutory audit is different, cost audit is different. Next question. Sir, is cost audit a regular audit or yearly audit or periodical audit? Answer again is no. Cost audit is not an yearly audit. It is not a periodical audit. It is not like statutory audit. Now, next question. Sir, cost audit is mandatory. Cost audit is mandatory on which kind of industries? Cost audit is mandatory on manufacturing, mining, processing, production, extraction, assembling companies. Sir, why? Because these companies, what are the common things they have? They make the use of raw material and labor. And wherever the raw material and labor will be used, along with the normal books of accounts which the company generally prepares as per section number 128, you also have to maintain the cost records in that case. But cost records when you will maintain if your turnover is greater than equals to 35 crores. Where it is written, rule number 3 of cost records and audit rules 2014. So if your company is making the use of raw material and labor and the total turnover of the company is greater than equals to 35 crores, along with the normal books of accounts, that company also has to maintain what? Cost records. Did you get the point or not? Yes. Next, cost records when applicable, as I already told you, rule number 3 of CRA rules. Sir, what is CRA rules? Cost records and audit rules 2014. If your turnover is greater than equals to 35 crores, the company has to start maintaining the which records? Cost records. Next most important thing which you have to understand here is, sir, is audit compulsory? Is cost audit is compulsory? Answer is no. Actually, what the central government has done, central government has divided all the manufacturing production companies in India into two categories. List A category, List B category. What are the two categories? List A category and List B categories. List A category and List B category. Now, List A category mein central government has kept the regulated sectors, and List B category the central government has kept the 33 industries which are unregulated sector. So central government has divided all the companies in India which are into the manufacturing into two categories, List A category and List B category. In the List A category, it is regulated sector comprising of 6 industries. In the List B, it is unregulated sector comprising of 33 industries. So do we have to know the names of the industries? Answer is no. That is a part of your CMA course, not the CA course. If your company is falling under List A category and the annual turnover of that company from the production and manufacturing of goods and services is greater than equals to 50 crores, and condition number 2, turnover from such goods and services for which cost records are required to be maintained is greater than equals to 25 crores also. Say for example, you are a company with 160 crores of turnover. It means you are from List A category. Say for example, you are from List A category and your total turnover of the manufacturing of goods and services is 160 crores. It means condition number 1 is satisfied. But this is and it means second condition is also required to be satisfied. What is second condition? This 160 crores of turnover is from, say for example, 5 goods. What are the 5 goods you are manufacturing? 5 goods gave you the turnover of 160 crores. But in this 5 good, there is only 1 good for which cost records are required to be maintained. And the turnover from that 1 good for which cost records are required to be maintained is 40 crores. It means your condition number 2 is also satisfied. The total turnover should be greater than equals to 50 crores, and turnovers of such goods and services for which what records are required to be maintained, cost records are required to be maintained, that should also be greater than equals to 25 crores. Then, being a List A category regulated sector company, your cost audit will become compulsory. Otherwise, cost audit will not happen. Same is the case with the List B category. If your company is falling under the unregulated sector of 33 industries, then when the cost audit will become applicable, if your overall turnover for the one financial year is greater than equals to 100 crores, instead of 50 crores, it is changed to now 100 crores because you are in the List B category. List A category है तो 50 crores है greater than equals to 50 crores. List B category है तो greater than equals to 100 crores. And your average turnover from such goods and services for which cost records is required to be maintained has been changed to 35 crores or more. So it means this turnover of 50 crores becomes 100 crores in List B category, and this turnover of 25 crores becomes 35 crores in list B category. Remember, both the conditions are required to be satisfied. Then only cost audit is required. Otherwise, cost audit is not required. Are you understanding the point? Otherwise, the cost audit is not required. Is it crystal clear, everyone? Yes or no? Yes. Otherwise, cost audit is not required. Okay? Now, what is the next point you have to understand? So that's what I kept on telling you. Cost audit and statutory audit are not same. The cost audit is only required if in the list A category, your average annual turnover is greater than or equals to 50 crores and turnover from such goods and services for which the cost records are required to be maintained is greater than or equals to 25 crores. And list B category mein average turnover is greater than or equals to 100 crores annually, or turnover from those goods and services for which cost records are required is also greater than or equals to 35 crores. Then in that case, cost audit will take place. It means it is not an annual audit, it is not a statutory audit. But suppose you are satisfying all the conditions of cost audit, but your company is operating from SEZ zone. Sir, what is SEZ? Special Economic Zone. If your company is located, if your company is a manufacturing company, but it is located in SEZ zone, if I have to give you the example, there is one place near Vizag that is called Duvada. In the Duvada, Vizag steel plant is operating from SEZ zone. So Vizag steel plant is, exempted from the cost audit. So if your company is into the manufacturing activity and operating from SEZ zone, then in that case, cost audit is not required. Or your company is a 100% EOU. Sir, what do you mean by 100% EOU? 100% export oriented undertaking means whatever you are producing, you are exporting it. Sir, why this exemption has been given? Because when you export, you increase the foreign reserves of the company. Because your payments will come in the foreign currency. So it means you are helping the company, helping the country like India in maintaining its foreign reserves. So yes, you will get an exemption if you're a 100% EOU. Sir, what about the normal export turnover companies? Normal export companies also will get the exemption, but more than 75%. More than 75% of their total turnover should come in foreign currency. If out of the total turnover, more than 75% of the turnover is coming in the foreign currency, then you will also get the exemption. If you are a small and medium enterprise manufacturing unit, then also you will get the exemption under the cost audit. Cost audit is not required. And if you are a company having your own power plant, you are generating and producing own electricity, and not only that, you are using such electricity for your captive consumption, then also you are exempted. So if you are any of these 5 categories of the companies, you will be exempted from the cost audit, everyone, even though you are satisfying the conditions in the list A category or list B category. No cost audit is required. Next one. Sir, who will conduct the cost audit? As I already told you, only practicing CMAs will conduct the cost audit. In case he is not available, then this opportunity might be given to the practicing CA. But only and only practicing CMAs are allowed. So practicing CAs are generally not allowed. Who can only do? Practicing CMAs can only do. Practicing CAs cannot do. But as we know that there's a scarcity of practicing CMAs in the market, so sometimes this may be given to the practicing CA. Right? Now, when we do the statutory audit, we all know that while doing the statutory audit, we have to see that the company has followed GAAP or not. We have to see that company has followed accounting standards or IND-AS or not. And while doing the audit, we have to see that if we are following standards on auditing while doing the audit or not. Same way, practicing CMAs while doing the cost audit, they have to see that whether the client company has followed GAAP or not. So GAAP has been changed to GAAP here. Generally accepted cost accounting principles. And we also have to see that their cost accounts or cost statements are prepared not by following accounting standards, but by following cost accounting standards, उसे हम बोलते हैं CAS. There are total 24 cost accounting standards in the CMA course. So client company is expected to follow GAAP, generally accepted cost accounting principles, and CAS, cost accounting standards. And while doing the audit of this client, we have to follow CAAS. In general audit, in statutory audit, we follow it as essays. But in the cost audit, we are going to follow CAAS, that is called Cost Auditing and Assurance Standards. We have only 4 cost auditing and assurance standards that we have to follow. So in the normal audit, in the financial audit, we see GAAP and AS and follow SS. In the cost audit, we see GAAP and CAS to be followed by the management, and we are going to follow CAAS, that is called Cost Auditing and Assurance Standards. That is how the cost audit is different from statutory audit. Next point. So what are the disqualifications of the cost auditor? Remember one thing, if you are a cost auditor of a particular company, you cannot be the statutory auditor of the same company. It means cost auditor of one company and the statutory auditor of the same company cannot be the same person. It has to be separate. They both should be separate person. They cannot be the same persons. Cost auditor of the company cannot be the internal auditor of the same company. Cost auditor of the company cannot be the tax auditor of the same company, but the cost auditor of the company can be GST auditor. Can be the which auditor? GST. So these 3 are disqualifications. This one is qualification. He can be GST auditor, but as you all know that GST audit has been abolished. So it means this is also not possible. But you will write it in the examination. Next, who appoints the cost auditor? He is getting appointed like a subsequent auditor of the government company. Now you tell me, who appoints the subsequent auditor of the government company under section 139 subsection 5? Under section 139 subsection 5, subsequent auditor of the government company is appointed by CAG, C&AG within 180 days from the commencement of financial year. But here, cost auditor is going to be appointed by board of directors of the company within 180 days from the commencement of the financial year. So by the board of directors within 180 days from the commencement of financial year. So he is appointed like a subsequent auditor of the government company. But subsequent auditor of the government company means CAG will appoint. But here who is appointing? Here board of directors is appointed. Time period is same, within 180 days from the commencement of financial year. So within how many days he has to complete the audit? He must complete his cost audit within 180 days from the end of the financial year. So you have been appointed within 180 days from the commencement of financial year, and you are expected to complete your audit within 180 days from the end of the financial year. Sir, iski remuneration कौन decide करेगा? As you all know, remuneration is always decided by the members. Now, when the board of directors have appointed a cost auditor, sir, do we have to intimate this to central government? Answer is yes. Board of directors will intimate to central government in form number CRA2. Cost records are required to be maintained in form number CRA1. Whereas we have to intimate that we have appointed the cost auditor to the central government in form number CRA2 within 30 days from the date of appointment, or within 180 days, whichever is earlier. Within 180 days from the commencement of financial year, or within 30 days from the date of appointment, whichever is earlier. Board of directors have to intimate this to the CRA, to the government, central government in form number CRA2, if we have appointed the cost auditor. Suppose if your cost auditor dies or resigns or getting removed, means casual vacancy, so same here, same board of directors will fill up the casual vacancy within 30 days, and again we have to intimate to the central government in form number CRA2 that we have again reappointed a new cost auditor, and that intimation is also going to be given in CRA2 within 30 days. Did you get the point or not? So if the cost auditor dies, resigns or removed, casual vacancy will be arising, and who shall fill it? Board of directors within 30 days shall appoint a new cost auditor, intimate again to the central government in form number CRA2 within 30 days. Next, sir, when the cost auditor completes his audit report, the cost auditor has completed his audit, is he going to send the cost audit report to the central government? Answer is no. Who appointed him? Board of directors. So he will send his cost audit report to the board of directors. Now, board of directors have received the cost audit report. If the cost auditor has kept any qualifications, modifications, or reservations, then the board of directors have to explain and pass the comment on such qualifications, modifications, and reservations which were kept by the cost auditor. And within 30 days of receipt of this report from the cost auditor, the board of directors, within 30 days of the receipt of the cost audit report, board of directors shall forward this report along with their comments to whom? To the central government in form number CRA4. To the central government, they have to inform it in form number CRA4. Did you get the point or not? Remember, cost records are form number CRA1. Intimation to central government is form number CRA2. Correct? Cost audit report is form number CRA3. Cost audit report is required to be given by the cost auditor in format of CRA3. And cost audit report plus board comments we are sending to central government in form number CRA4. So these four form numbers you have to remember: CRA1, 2, CRA1, 2, 3, 4. CRA1 is for cost records. CRA2 is for intimation for appointment of cost auditor to the central government, and casual vacancy again intimation to central government. And CRA3 is the cost audit report which the cost auditor has to send it to board of directors, and board of directors, after passing their comments, they will attach their comments and will forward it to within 30 days to the central government in form number CRA4. Are you getting the point? So this is what do you mean by the provisions relating to which audit? Cost audit. So I hope section number 148 went sincerely inside your head. Clear everyone? Yes or no? And removal of the cost auditor again by the board of directors after opportunity of being heard by passing a board resolution. If you want to remove a cost auditor again will be removed by the board of directors after opportunity of being heard by passing a board resolution. Now section number 177, as you can see that this one anyways we are going to cover in the audit committee and corporate governance, so there's no point of doing this section here. Clear everyone? So with this, our company audit ke section number 139, 140, 141, 42, 43, 44, 45, 46, 47, and finally 148 is also over, except CARO 2020, that is 143 subsection 111. Now that I already told you, we'll cover in the audit report chapter, right? Now let's move to the next chapter, that is called Books of Accounts chapter. What is the next chapter, everyone? Books of Accounts chapter. Are you getting the one? Maintenance of books of accounts, right? Now, as you all know that in the maintenance of books of accounts, we have to cover section number 128 to section number 137. This is a list of sections which we are going to cover. That is section number 128 to section number 137. This is relating to your chapter called Maintenance of Books of Accounts. Clear everyone? Yes or no? So now let's start with the topic called Books of Accounts and Financial Statement. So here we are going to cover section number 128 to 137. Now 128 talks about the books of accounts, 129 talks about the financial statement, 130 talks about the reopening of books of accounts and recasting of financial statement, 131 talks about voluntary revision of board report or financial statement, 132 is NAFRA, National Financial Reporting Authority, very important section. 133 talks about central government prescribing the accounting standards. 134 talks about the board report. 134 subsection 1 signatories of financial statement. 134 subsection 3 which talks about the director responsibility statement. 135 CSR where the small amendment has come relating to COVID-19. 136 sending the financial statement copies to members, and 137 that is filing the financial statements with ROC. So these are the sections we have to cover this lecture, and I think the next two lectures will be dedicated on this along with the dividend chapter. Clear? So I will try my level best to cover up this in the next two lectures along with these sections, along with that 123 to 127 that is called your dividend chapter. After that we'll directly jump to the professional ethics, right? So once the professional ethic, company audit, books of accounts and dividend chapter will be over, so we can say that our 30 to 40% of the marks will be completed in the revision series of RRB batch main for and November 22, right? Now, let us understand section number 128. You can see that section number 128 talks about what? Books of accounts. अब इसको ध्यान से सुनना. Sir, what is section number 128? It is talking about the books of accounts. What is the meaning of books of accounts and what are the features of books of accounts? Where the books of accounts, for how long the books of accounts are getting preserved, and what are the inspection for the books of accounts? Who can inspect the books of accounts? Books of accounts in the electronic form, and keeping key responsible persons for the books of accounts and penalty on non-compliance. So first, let us understand section number 2, the definition of books of accounts. Dekho, whenever we talk about the books of accounts, there are total 4 types of books of accounts. So what are the 4 types of books of accounts? The 4 types of books of accounts are books of accounts of assets and liabilities, books of incomes and expenditure, books of sales and purchase, and cost records, if any, which is required by the manufacturing company. So there are total 4 types of books of accounts: assets and liabilities, sales and purchase, incomes and expenditure. Now, what are the features of books of accounts? As you all know that books of accounts helps in preparing the financial statement. So financial statements are generally summarized in nature. It means if the financial statements are summarized in nature, then what is explanatory in nature? Books of accounts are always what in nature? Explanatory in nature, because they are consisting of daily routine sale, purchase, assets, liability, income and expenditures. Next point, if the financial statements we expect it to be true and fair, books of accounts also has to be true and fair. And books of accounts are always prepared on accrual basis of accounting if you are a corporate entity. If you are a non-corporate entity, you have a choice of maintaining your books of accounts on accrual basis or cash basis. That's your choice. But being a corporate entity, it has to be on accrual basis of accounting, and books of accounts are always prepared on double entry system. So these 4 are known as the features of the books of accounts. Next thing, sir, where do we generally keep the books of accounts? Books of accounts are generally required to be kept at a registered office. But sir, what if the registered office is outside India? Then it has to be kept outside India. But quarterly basis, it is required to be sent to India. Sir, what if I'm a dependent branch? If you are a dependent branch, your books of accounts will be taken care of by whom? Your books of accounts will be taken care of by your books of accounts will be taken care of by your head office. Are you getting the point? So if you are a dependent branch, your books of accounts will be taken care of by the, maintained by the, preserved by the, kept by the head office. Generally, books of accounts are kept at registered office, but if the registered office is outside India, those books of accounts are required to be sent to India on which basis, everyone? Quarterly basis. This question they may ask you ki semi-annually, annually or weekly basis. It is quarterly basis. Such set of books of accounts must be sent to India. Sir, I want to change the place of keeping the books of accounts. Can we change the place of keeping the books of accounts? Answer is yes. We can change the place of keeping the books of accounts. Yes, by passing a board resolution, we can change the place of keeping the books of accounts, but within 7 days of passing the resolution, new communication address where you are now keeping the books of accounts has to be intimated to ROC within 7 days of passing the board resolution in form number AOC 5. You have to intimate the new address. That is called meaning and the features of books of accounts. Next point, sir, books of accounts are required to be preserved and required to be inspected. Yes. If the company is in existence, for less than 8 years, if the company is in existence for less than 8 years, you must preserve the books of accounts for all the financial years. But if the company is in existence for 8 or more years, then in that case, at least 8 accounting years books of accounts must be preserved. Next point, if any inquiry, inspection or investigation is going on the company, then till the time that inquiry, that investigation or that inspection is not getting concluded, till that time you have to preserve the books of accounts. Say for example, the queries took 15 years to get concluded. So you can't dispose these books of accounts after 8 years. You have to preserve it till the time that inquiry, investigation or inspection is not getting concluded. So this is what brings an end to your preservation of books of accounts ka topic. Next point, sir, who can inspect the books of accounts? Books of accounts members can't inspect. Sir, what? Yes, you heard it right. Members can't inspect the books of accounts. but because membership and management, board of directors, क्योंकि books of accounts are generally prepared by board of directors. Financial statements are also prepared by board of directors, but financial statements can be inspected by the members because that is their right. But books of accounts is not their right. Books of accounts cannot be inspected by the members. It is prohibited. Only directors can inspect. And if the directors are inspecting, then there is no cost of inspection. But anybody else other than directors are inspecting, then 50 rupees per person per inspection is the cost of inspection of books of accounts. And if you want to take extracts or copies of the books of accounts, you will end up paying rupees 10 per page. Remember, the same rule is there in LLP Act also. LLP Act may be cost of inspection is 50 per inspection, but there the cost of extraction or extracts or copies is 5 rupees per page, but here it is 10 rupees per page. Are you getting the point? Next point, sir, if the books of accounts are kept outside India, then also can Indian director inspect it? Yes. What the Indian director will do? Indian director will make a request to the company, and the company shall make sure that within 15 days of his request, those books of accounts must be produced in front of him. Did you get the point? So within 15 days, those books of accounts must be produced in front of him. To whom? To the Indian director who has requested to see the books of accounts which are outside India. Is it clear, everyone? The books of accounts, if kept outside India and the Indian director wants to inspect it, those books of accounts shall be revert back to India within 15 days of his request. Next point, sir, if the director himself is inspecting the books of accounts, is there any restriction? Answer is no. Company cannot restrict a director from inspecting any information, let it be secretive information or sensitive information or confidential information. If the director himself or herself is inspecting, there is no limitation on that. But if the director himself is not coming, he is sending his agent or legal representative or power of attorney holder or relative. In that case, if the company want, they may restrict some access to some those informations which are little bit secretive, confidential in nature. Then in that case, company can stop them from accessing or can restrict them from accessing such books of accounts which are little bit sensitive, confidential in nature. The director himself is doing, no such a restriction. He is sending someone else, some restriction. Now, next point. Can a holding company directors come and inspect the books of accounts of subsidiary company? Generally not allowed. But there is one small exception. If the whole board of directors of that holding company authorizes one director, whole board of director means 100% consent of the board of directors of holding company required, and they authorize one director, that one authorized director can go to the subsidiary company and is allowed to inspect the books of accounts there. So did you understand the point? Yes or no? So who can, who cannot inspect it? Directors can't, directors can, members can't. Cost of inspection 50 per person. If the directors, no cost. And cost of extraction or copies rupees 10 per page. If the director himself is inspecting, there is no any kind of restriction. He can access to any information. But if he is getting it inspected via his agent, LR, power of attorney or relative, then sensitive or confidential information, if their own company does not want them to access it, so then company can do that. Company can restrict them. Next point, sir, what if the books of accounts are lying outside India and the Indian director wants to inspect it? Okay, registered office is outside India. Then within the 15 days of his request, those books of accounts must be produced in India. So can the holding company director go to the subsidiary company and do the inspection? Answer is generally no. No, not allowed. But yes, sometimes it is allowed. If one authorized director, authorized by all the directors of the holding company, can go and inspect the books of accounts of subsidiary company. Next point. Sir, what if the books of accounts are required to be maintained in electronic form? Remember, if you want to prepare the books of accounts in electronic form, there are 6 conditions required to be satisfied. Sir, how many conditions? 6 conditions required to be satisfied. Condition number 1. If you are preparing and maintaining and preserving your books of accounts in electronic form, make sure that it must be stored and preserved it should be stored and preserved on Indian cloud server. You are not allowed to take the foreign server for preservation and maintenance and storing of books of accounts in electronic form. So your books of accounts in electronic form must be preserved and stored on Indian cloud server. Next point, it is only and should be only allowed to be accessed in India. So it is accessible only and only in India. Condition number 2. Daily, 2 backups you have to take of your books of accounts. One is on-site backup, which you have to keep at the company, and one is off-site backup at a place other than company. So daily you have to take the 2 backups. One is on-site backup and one is off-site backup. The point number 1 must be stored on Indian cloud server, only accessible in India, daily on-site and off-site backup, and make sure that you are maintaining the books of accounts in electronic form. You are not allowed to maintain it in any other form. Make sure that it displayable in the original form only, like a trading P&L and balance sheet. So you are not allowed to do it on your own. Clear? Next point. Did you get the point? Next point kya hai? Now next point mein your books of accounts must have this following feature. Sir, what is this feature? Your books of accounts must have the following features. So what is the feature? Your books of accounts must have the 4 features. What are the feature? Number 1, your books of accounts in electronic form must be storable in nature, printable in nature, retrievable in nature, displayable in nature. They should have the features of elements or capacity of storage. It should be printable, it should be retrievable, and it should be displayable. Next point, in case of branch books of accounts, because you are a head office and you have a dependent branch, you will maintain the books of accounts. Make sure that you are maintaining the books of accounts of the branch in an unaltered form. You are not allowed to change it in any way. And not only that, after these 6 conditions, first of all, to tell me all the 6 conditions. Condition number 1, must be stored on Indian cloud server, accessible only in India, daily on-site off-site backup, must be maintained in original form, must have a capacity of storage, printing, retrieval, and display, and in case of branch books of accounts must be maintained in unaltered form. And make sure that you are filing these 4 informations to the ROC. Name of your internet service provider. Which internet service provider is providing you the internet service in your company? Name of the internet service provider or network service provider. Internet protocol address of the internet service provider and network service provider. This information also you have to file with whom? ROC. Location of internet service provider and network service provider. Manner of retrieval of information. All these informations are required to be filed with whom? ROC. Next point. Sir, who are the key responsible persons for maintaining the books of accounts, and what is the penalty if they do not maintain the books of accounts in the proper manner? Remember one thing, the key responsible persons for maintaining the books of accounts is the managing director of the company, whole-time director of the finance department of the company, and CFO. These are the 3 people who are the key responsible persons, KRPs, for maintaining the books of accounts as per section number 128. If none of these person is available in the company, then all the directors will be treated as what? All the directors will be treated as, they will be treated as KMPs. Did you get the point or not? All the directors will be treated as KMPs. Next point. Sir, what if the MD, whole-time director and CFO is not there? Then all the directors will be treated as KMPs. But remember one thing, what is the penalty if the books of accounts are not maintained as per section number 128? That is a minimum fine of 50,000, maximum of 5 lakhs or imprisonment up to 1 year or both. This is the section number 128 which talks about books of accounts. I hope you are able to see that whole section. The meaning and feature we have covered here. Preservation and inspection we have covered here. Books of accounts in electronic form we have covered here. Key responsible persons we have covered there. So this is what brings an end to your section number 128. Now, section number 129. भैया ये तो बहुत important section है. It talks about financial statement. Sir, when we talk about the financial statement, 5 things comes to your mind. Balance sheet, P&L, cash flow statement, notes to accounts, and statement of changes in equity. So what are the 5 things? balance sheet, P&L, cash flow statement, notes to accounts, and statement of changes in financial statement. Sir, from the financial statements, what do we come to know? From the balance sheet, we'll come to know about the financial position of the company. From the P&L, we'll come to know about the financial results and profitability of the company. From the cash flow statement, we'll come to know about the flow of funds. And from the notes to accounts, we'll come to know about the notification and disclosures relating to accounting standard schedule 3 and accounting policies. And statement of changes in equity gives us the information about how much equity has been changed as compared to the last year. What is the shareholding pattern has changed. But remember, cash flow statements in the financial statement, cash flow statement is not applicable if you are a OPC. If you're a one-person company, you need not prepare the cash flow statement. If you're a small company, you need not prepare the cash flow statement. If you're a dormant company, you need not prepare the cash flow statement. And if you're a startup private company and you are declared as startup by the Department of Promotion for Internal Trade and Industries. So if DPIIT Department for Promotion of Industries and Internal Trade has declared you as a startup private company. Remember, private company, public company though always, and not all private companies, only startup private companies, and those startup private companies which are declared as startup by the DPIIT, Department for Promotion of Industries and Internal Trade. And this department is located under Ministry of Corporate Affairs. So what are the 4 companies to whom cash flow statement is not applicable? So bhaiya, it is not applicable to one-person company, small company, dormant company, and startup private company. Is it crystal clear? Yes, sir. Next one. Sir, who are the users of financial statement? Our financial statement, why company prepares the financial statement? So that they can satisfy the management, shareholder, government, employee, lender, suppliers, and research scholars. Remember one thing, these people use the financial statements of the company for their different purpose. Say for example, management for the decision making, shareholder for the profitability and consistency of business, government is looking for taxation, employees are looking for retirement benefits and employment benefits, lenders use the financial statement so that they can check the repayment capacity of the client, suppliers use the financial statement so that they can check the credit worthiness of the company. Research scholars use the financial statement so that they can talk about the investment opportunities and trend evaluation of the company. Is it clear, everyone? Yes or no? Yes. Now, next point. Sir, books of accounts or financial statement के features में what is the difference between them? As you all know that books of accounts are explanatory in nature, but financial statements are summarized in nature. Books of accounts and financial statement both are expected to give the true and fair view because financial statements are prepared from books of accounts. So if the books of accounts are true and fair, financial statements are expected to be true and fair. Books of accounts are maintained on double entry system. Financial statements are prepared by compliance of accounting standards and IND-AS. Books of accounts are accrual in nature. They are based upon the accrual basis of accounting, but financial statements are to be prepared as per Schedule 3 requirement. Did you get the point? These are the features difference between books of accounts. And most important thing, if you are a banking company and if you are an insurance company, if you are an electricity company, if you are a defense production company, तो भैया section number 129 is not applicable to you because as a banking company, insurance company and electricity company, you are regulated by your respective acts and you have your own financial statements ka set of accounts. You have your own format of financial statement. You need not follow the format of financial statement of Schedule 3 of Companies Act as well as section number 129. Sir, who has given this exemption? NFRA has given this exemption in consultation with central government. So NFRA in consultation with National Financial Reporting Authority in consultation with central government has given this particular exemption to banking company, insurance company, electricity company, and those companies which are into the production of what? Defense production goods. जैसे BEL, Bharat Electrical Limited or Electronics Limited, which is into the manufacturing of gunpowder, guns and tanks and all. So you are not expected, you are exempted from section number 129 and Schedule 3 requirement because you will follow the financial statements format of your respective acts as you are the regulatory companies. Right or wrong? Next point. Earlier, what used to happen? Earlier, if you are a holding company, in your AGM, your own standalone financial statement you used to lay down and consolidated financial statements of the group. That's it. Your own financial statements and consolidated financial statement. But nowadays, If you are a holding company, if you are a parent company, your responsibility has increased. Now in your AGM, your own standalone financial statement definitely will come. Cash flows, consolidated financial statement of the group also definitely will come, same as it is. But what is the change? The separate standalone financial statement of all your subsidiaries, associates and joint ventures also will be laid down in the same AGM. This is the new amendment. So not only your standalone financial statement, the standalone financial statements of your subsidiaries, associates and joint ventures are also going to be laid down in the same AGM. Now, next one. Sir, what is the exemption from consolidation? Remember one thing. अब इसको ध्यान से सुनना. Exemption from consolidation to intermediate wholly owned subsidiary. Exemption from consolidation of financial statements to which subsidiary? Intermediate wholly owned subsidiaries as well as partially owned subsidiaries. First of all, to understand, if you are an intermediate wholly owned subsidiary and you are a parent of some another company, you are an intermediate wholly owned subsidiary. It means you are a subsidiary, but wholly owned subsidiary. You are also a parent of some other company. You need not do the consolidation of financial statement. You will get an exemption. And if you are a partially owned subsidiary also, then also you need not do the consolidation. You will get an exemption. If you want to get an exemption as an intermediate wholly owned subsidiary, there are two conditions to be satisfied. But if you want an exemption from consolidation of financial statement as a partially owned subsidiary, then in that case, three conditions are required to be satisfied. Now, इसको ध्यान से सुनना. Now listen to this. फर्स्ट अपन बात करेंगे इंटरमीडिएट होली ओन्ड सब्सिडरी की. Now suppose A is the 100% holding of B. It means in the B, 100% of the voting rights of the B are held by whom? A. So what is B? B is a wholly owned subsidiary of A or not? Yes or no? Yes. Now B is holding 70% of the voting rights in what? C. B is holding 70% of the voting rights in what? C. Now, when the B is holding 70% of the voting rights in C, now what is happening? Now, what is happening? अब इसको ध्यान से सुनना. Generally, as a parent company, you have a responsibility of doing the consolidation. So, A to will do the consolidation of A plus B plus C. But B has to do the consolidation financial statement of, has to prepare the consolidated financial statement of B plus C. Am I correct or not? Because B is also a parent of whom? C. But B may get the exemption. B may get the exemption from doing the consolidation. So this is called exemption of consolidation to the intermediate wholly owned subsidiary. But B will get this exemption when B need not prepare the consolidated financial statement of B plus C. When the B will get an exemption if the two conditions are satisfied. Sir, condition number 1, your immediate parent company must be located in India. Condition number 1, your immediate parent company must be located in India. Matlab, what is the B's immediate parent company? B's immediate parent company is A. A must be located in India. If the A, its parent company, whose B's parent company, A, is located outside India, B will not get any exemption. If B wants to get an exemption, its parent company must be located in India. Matlab, A must be located in India. Condition number 1. And condition number 2, B should not be a listed company or going to be a listed company either in India or outside India. It means this intermediate wholly owned subsidiary exemption from consolidation of financial statement is not at all applicable to the listed companies either in India or outside India, or going to be listed companies which have applied for listing in India or outside India. You people are not going to get any such exemption. Means listed company को consolidation करना ही पड़ेगा. Listed company must have to prepare a consolidated financial statement. They will not get any kind of exemption. So to get this exemption by the B, if the B wants this exemption, so B's immediate parent company A must be located in India, and B should not be a listed company in India or outside India, or not going to be listed in India or outside India. These two conditions are satisfied, then as an intermediate wholly owned subsidiary, you will get the exemption. You need not do the consolidation of A plus, sorry, you need not do the consolidation of B plus C. So who will do that? Your immediate parent company will do that, but if that is located in India. Now, this exemption is also available in case of partially owned subsidiary. Now, look at this example. A is holding 60% voting rights in B now, and B is holding 70% of the voting rights in C now. अब तुम मुझे बताओ, is B a wholly owned subsidiary of A, or is B a partially owned subsidiary of A? B is the partially owned subsidiary of A, not the wholly owned. If the A is holding 100%, then B is a wholly owned subsidiary. But now A is holding only 60%, therefore it is only and only what? It is only and only partially owned subsidiary. Now, if B wants again an exemption from doing the consolidated financial statements of B plus C. Now, B does not want to do that. Yes, B can get this exemption. But now, three conditions to be satisfied, out of which two we already know. It's immediate parent company. Who is immediate parent company? A must be located in India. A must be located in India. And B should neither be a listed company in India, nor be a listed company outside India, nor going to be a listed company in India or outside India. But sir, what is the next provision? Now listen to me very carefully. Very, very carefully. Now listen. How much A is holding the voting rights in B? 60% voting rights. It means in the B, remaining 40% are what? Minority interest. They are known as non-controlling interest. 60% is the controlling interest by the A, but in the B, 40% are what? Non-controlling interest. It means those 40% may raise the objection कि why B is not preparing the consolidated financial statement of B plus C. It means if B wants to get the exemption, being a partially owned subsidiary, because in the wholly owned subsidiary this condition was not there, because in the wholly owned subsidiary A was holding 100%. So immediate parent company will agree, okay, I will prepare, you don't prepare, get the exemption. That's the reason this condition was not there. Now, what is the condition? The 40% who is the non-controlling interest as per INDAS and minority interest as per the accounting standards, B company has to send them a notice. Do you have any objection if I do not prepare the consolidated financial statements of B plus C? If none of the 40% of the non-controlling interest shareholders say any objection, then only B can get the exemption. If any of that non-controlling interest members or non-holding interest or minority interest members raise any objection, B will not get this exemption. So B will only get this exemption if all the non-holding interest or minority interest shareholder will give what? Will give permission to the B in writing that we do not have any objection if you do not prepare the consolidated financial statements of B plus C. So what are the three conditions to be satisfied? Condition number one, B neither should be a listed company nor going to be a listed company in India or outside India. Condition number two. What is the condition number two? The immediate parent company must be located in India. Condition number three. What is the condition number three? B must have sent notice to the non-holding members for not doing consolidation of financial statements of its subsidiary, associate and joint venture, and the non-holding members have no objection if the B is doing that, and such partially owned subsidiary is having a proof of it कि non-holding members have no objection in that. If it does not have a proof that कि non-holding members are not having any objection, then this exemption will not be provided. Are you getting the point? This exemption only will be provided if the non-holding members will give no objection to the B in writing. Are you getting the point? Yes or no? Yes. So this is what do you mean by section number 129. Now, how many layers of holding subsidiary are allowed? That you already know. Only two layers are allowed. If A is the 80% voting right in B and B is the 60% voting right in C, C is a subsidiary of B, C also a deemed subsidiary of A. So that is called layer 1, layer 2. This two-layer relationship is allowed. But nowadays, three-layer relationship is allowed if anywhere 100% subsidiary is there. So among all the three layers, if there is any 100% subsidiary, then only three layers are allowed. It means that D, if suppose there is no 100%, suppose if there is no 100%, it means D is the subsidiary of C as well as D is the deemed subsidiary of B. But D is not a deemed subsidiary of A because three layers are not allowed. But if anywhere 100% wholly owned subsidiary is there in any of the three layers, then D is also a subsidiary of C, D is also a subsidiary of B, D is also a subsidiary of A because there is 100% subsidiary among the three layers. You can see that there it is 100%. It can be here also, it can be here also. And last but not the least, so what is the penalty on the non-compliance of section number 129? If the section number 129, like section number 128, is not followed properly, the key responsible persons, do you remember the key responsible persons in 128? They are the whole-time director of finance department, MD and chief financial officer. Or if they are not there, any of the directors, they will be held liable. Same penalty of 128 is applicable to 129. That is fine of minimum 50,000, maximum 5 lakhs or imprisonment up to 1 year or both. You can see that who are the key responsible persons for financial statements also. MD of the company, whole-time director of finance department and CFO. If not, then all the directors, what is the penalty if they do not prepare financial statement as per section number 129? Minimum 50,000, maximum 5 lakhs or imprisonment up to 1 year or both. This is what do you mean by section number 128 and 129. Done. So in this particular video, we have covered 148, very important section on cost audit, 128 books of accounts and 129 financial statement. The remaining sections, that is 130, 131, 132, 133, 134, 135, 136, 137 we'll cover in the next video. So next video is going to be a little bit bigger. That is going to be minimum 2 hours video. And then another one video I'll make on dividend chapter. After that, our 20 to 25 marks of portion will be over both in MCQ as well as a descriptive manner. So I'll see you guys in the next video, everyone. Thanks for watching it, and I hope I'm able to meet your expectations. And if you have any feedback to give to me, you can send an email to me on carohit.grover, carohit.grover@yahoo.com. So carohit@yahoo.com, right? So thank you so much for watching my video, and I'll see you guys in the next video. Bye everyone. Take care. Bye bye.